Okay, welcome back to the second segment of the evening. We are going to be having a panel, and so we are very grateful for the panelists that have joined us this evening. And so we are going to get ready to just talk about preparing for capital and essential financial documentation. And so again, cohort, if you do have questions, please go ahead and place them in the chat. And so the first thing that we are going to do is that we are going to allow both of our panelists to introduce themselves. And as more panelists join us, we will ask them to introduce themselves again as well. And so the first question that we have for each of you, we just want you to go ahead, share your name, share how you help small businesses every day, and then we are going to go ahead and get started. And so, Mr. Holmes, we will start with you.
Well, thank you, Dr. Coles. I'm wearing a different hat for the panel. My name is Will Holmes. I'm the founder of Baltimore Economic Leadership League. We started in 2021. And we are a nonprofit organization, a 501c3 community development financial institution that actually raises funds for small, minority, rural, and women-owned businesses in the state of Maryland. Thank you for having me.
Thank you very much. And then Mr. Ojuri.
Hey, how you guys doing? My name is Richard Ojuri from M&T Bank. I'm a business banking relationship manager. I cover the DMV area. I sit in Annapolis, but I do go all throughout the DMV. I help business owners by playing the connector. If we can't get you access to funding on the M&T Bank side, I work with many different CDFIs like FSC First, Meridian Management Group, and we're here to help you guys, to connect you to the right players to get you access to capital.
Thank you very much. And so I know we discussed some of this a little bit earlier on, but the first question that we're going to ask is, what should a business banking relationship look like? What tools or suites do each of the panelist institutions offer to help small businesses? Can they assist with any financial planning, cash flow management, or investment strategies?
Yes, we have many different programs here at M&T Bank. The first thing should be a deposit account, right? Deposit account where your cash sits in. And speaking with someone like myself, a business banking relationship manager, we don't sit in the branches, but if you talk to your local branch manager, they can put you in contact with someone like myself. And then sometimes we may not even be talking lending, right? We may be talking with fraud services, treasury management to help protect your account. Maybe talk a merchant. How do you receive payments? What type of equipment are you using? And then also, we hold many different internal programs to help our business owners like yourself know how to do cash flow. And we work with like Will Holmes, for example, right? Here at M&T Bank, we love Will Holmes. So we have a client that, doesn't really know about cash flow or something like that. Go out to Will's home, go join one of his classes and still be with us. And then when you're done with this program, we could talk.
Well, thank you for that, Mr. Ojuri. So let me tell you about BEL, which stands for Baltimore Economic Leadership League, and we are a CDFI, Community Development Financial Institution. So what's the difference? We don't have checking accounts or savings accounts like a bank. What we have are just loans, micro loans, and that you can use to grow your business. Now, we do have we use a 5C credit worthiness scoring system that a bank would use, but our requirements are more relaxed. You can have some credit challenges. You can have lower revenue. You can still have a job. If your job is showing that you can actually pay us back, that is great. We're here, and the money we receive from grants, for example, we received recently $50,000 from Truist. Also, we received money from other organizations like Maryland Aviation Administration and other large organizations who really care about small businesses. We use that money, we put it into a pot, and we lend it out at 0% interest rate. And then usually we haven't had anyone go to default yet. And in fact, I don't think we even had any late payments. And one of the things that we do to kind of ensure that is we really leverage these classes. We record all this information. So when someone has a problem, let's say with marketing, hey, watch this video on this, then contact one of our consultants at WHC, because WHC and BEL partner together. Contact some of the consultants at WHC. They can help you through that challenge. If they need more money than BEL can offer, then of course we're going to push them, especially after their credit score has gone up after working with us. We push them to M&T Bank or FSC First or other lenders who have more money. So that's what sets us apart, and we're excited to be on the panel tonight.
Thank you very much. And so we do have quite a few questions as it relates to debt and debt consolidation. But one question that we do have is, how does new personal bankruptcy affect your ability to receive loans? How does it affect your business credit?
So just to make sure I understand, you're saying how does bankruptcy affect your business acquiring loans? Okay, that goes into it's going to be harder per se to get kind of like a loan. It's not impossible at all, but it definitely makes it harder because we kind of want to know why you went into bankruptcy. Because if you went into bankruptcy, it means you couldn't pay back your loans. So we need to know the story behind that, right? So as a risk factor, that is a high risk because you're telling us that you can't pay back your loans. So as a banking institution, we wouldn't want to kind of give out a loan unless knowing the real reason to why you went into bankruptcy. Now, if you went into bankruptcy a long time ago, then we can talk. Maybe that was just a past, and you overcome that. But if it's something more recent, I'll probably 9 times out of 10 refer you to a CDFI to talk more about your lending opportunities.
So when Richard sends them to us, then we're going to ask a lot of the same questions. We really want to know the story, but now okay, that happened. So what are you going to do to fix it? And so we really want to look at your cash flow projections. If you haven't been through one of our programs, you go through like a mini crash course over a couple of days, and then from there we're going to want to know your plan. We really want to see and make sure that your projections are realistic. They're based on a reasonable market share, and we want to make sure that you really know your customer and their needs. If those things aren't in place, then we can't risk the money. Even though we're a CDFI and a small lender, the money that has come from stakeholders, and they expect us to be responsible. So if you show them the past, you don't pay, and you don't have a good plan on how you're going to fix it, we're not really able to help. We can give you advice on how to build your credit up over time, but we would be looking for you to show that you have a serious plan on how to grow your business.
Thank you very much. And so another question that we have from the cohort is, will lenders lend to a business for debt consolidation?
So you're saying, I'm sorry, I keep on asking, but you're saying, will a business lend to another business? So the business will be the guarantor.
I guess that is their question. I think they're inquiring about how a lender will lend to a business for debt consolidation. So they're trying to figure out if they could possibly get a loan to consolidate some of their debt.
Yeah. So yeah, we do that. This depends on what debt we're trying to do, right? So if we're trying to do a consolidation loan, let's say for example, we have a bunch of term loans out there that are just on a higher interest rate, then we'll just do a mass term loan to kind of to take control of that, and you'll be paying it all in a lump sum. And that so yeah, it's pretty much that.
And we do the same. Usually though, we have to partner with a larger organization because we only have so much money. But when we do that, we're very hands-on. So if you say that this is to pay $5,000 to this lender, we are taking that money and directly paying them off. We're not giving it to you and trusting you do it. We're directly paying them off directly. And after we pay them all off, then whatever additional money, let's say you took out 55 and the rest of it was 50, then that 5,000 left over, then we would deposit that in your account. But the other 50 will have gone directly to pay those other debts off.
Thank you very much. And I know that, Mr. Ojuri, you mentioned a term loan. And so someone did ask, do you recommend getting a 7-year term loan?
Yeah, that's a good question. It typically depends on what we're doing, right? There's no right or wrong answer to that. Just depends on what we're doing, right? The typical term length is about 5 years, I want to say. That's typical, like for equipment financing, vehicle, stuff of that nature. 7, we could talk about it. Now, of course, if it's a higher term loan, then that would make sense. It all just depends on what we're doing.
Thank you. Oh, go ahead. I'm sorry.
But I was going to say same thing.
Thank you very much. And so someone did ask, what is the average loan amount for term loans?
There is no average term loan amount. You can go as high as you want to, as long as your business can afford the debt.
Thank you very much. And so this person also asked, what is the best way to leverage the access equity in your property if you don't want to get a second loan?
Wait, can you repeat that, please?
I definitely can. So they asked, what is the best way to leverage the access equity in your property if you don't want to get a second loan?
So a HELOC is what I'm assuming. You're talking about a home equity loan. I mean, you could use that to do whatever you want to use. I don't recommend it. I use it as like a last thing because that's your personal house, right? You don't want to be using your personal house to fund your business, right? Now, if you have to do it, you have to do it. Your business has to go. But if your business can stand on its own, that would be ideal, and you can get funding through that, and then so that way it separates any debt that's for your business and any debt that's for your personal.
Thank you very much. And so another question that we have from the cohort is, what is the difference between using an SBA loan or a bank or Will's Bank?
First of all, SBA loan, I mean, to be honest, I may not give the best answer, but as a banker, my answer to that is I really don't think it really affects the consumer, more to say, right? The person doing it. The SBA loan just helps mitigate risk for the banks, so that, for example, if you have a more risky business, or you just haven't been in business for a while, it may be a risk. The bank will then, like an M&T, we are the number one SBA lender within our markets, number 1 or 2. So we'll go talk to the SBA, our in-house SBA team, and the SBA will take a certain percentage of the risk on, so that way the bank isn't just all skin in the deal. So for the consumer, like you guys, the business owners, all you guys see is just more paperwork on the SBA side. That's pretty much all, and then you have to abide by certain requirements for the SBA to qualify.
I can add on to that if I could, because we don't actually do the SBA backed loans, but we refer to our lenders who do it, like other folks who do it. So we have to kind of explain a lot. So first and foremost, right, the SBA is just backing the loan. So you're not borrowing money from the SBA. You have to go to an approved lender like M&T Bank, who does the most in the whole region. They're great at this, right? So you have to go to a bank. They have someone who specializes in it. And so the main differences between the SBA-backed loans and other types of loans is really, one, the government guarantee really allows the bank to basically do a riskier loan they wouldn't normally do. And especially if there's a weaker credit score or a newer business. Like you can get an SBA-backed loan and buy a completely brand new business. Now you have to do a considerable amount of paperwork. Also, as I mentioned before, your SBSS score has to be at 155 or higher, and your personal credit score has to be at 660. At least as of like May 1st. That's the last time I looked at it. Usually it's easier qualification because they're trying to stimulate the economy. Usually the loan terms are longer. It's like if M&T Bank's on 5 or 7, SBA may do 30. Interest rates are usually a little lower than you would get anywhere else based on your credit score and your business revenue. There's also like the SBA puts like limits on the types of interest rate someone can charge. And then loan amounts, at least from what I remember, often they are usually I see them smaller. I mean, I don't usually see anyone getting like a $10 million SBA backed loan, but I have to double check on that. But usually those are the things that when we work with a client and we have to explain to them before we refer them to like one of our SBA lenders.
Thank you very much. And so this person did just ask a follow-up. If you're able to just provide a little bit more clarity in terms of how does the rate vary between an SBA loan versus a bank loan?
Yeah, I think Will just hit nail on. I think SBA is typically always going to be kind of smaller than some banks' rates for the most part, because they're standard, I want to say. Not like everyone gets the same rate, but they do have a pricing tool that they do that's pretty consistent among both of their loans.
Yeah, absolutely. Yeah, the SBA loans are not definitely, but in most cases lower than what you'll get at the bank because it's an economic stimulus tool. and we just print money anyway. So it's.
Thank you very much. And so another question that we have from our cohort is, what kind of collateral should we use when applying for a loan? Are you able to provide specific examples?
Yeah, that's a wonderful question, right? Think of it as like your collateral should make sense in a sense, right? So for example, if you're talking about lines of credit, those typically don't have collateral because they're unsecured lines of credit. Now, if we're talking about term loans, those are normally secured by whatever you're paying for. So if you're going out and you're getting equipment, that collateral is going to be the equipment. If you're going out and getting a commercial building, the collateral is going to be a commercial building. Going out and getting a vehicle, the vehicle is going to be your collateral. Now, there are instances where like the bank or a CDFI can become a little bit unique with their credit facility, and they'll use your like insurance, or they'll use like something that you own to then kind of help with a line of credit. Most traditional banks won't really do that on the small business side. I have seen banks get more kind of strategic on bigger deals, but for the most part, for like those small business deals, they're pretty much black and white with the collateral piece on your traditional bank side.
Agreed. I think we just had another panelist, Mr. Eric Stewart, who is amazing when it comes to real estate investing. He, I think, just joined us. Dr. Coles, I'll stay on the panel. You do your thing.
Thank you very much. Welcome, Mr. Stewart, for joining us this evening. We did just want to ask, if you don't mind, just share with us your name, the business that you are affiliated with, and how you help small businesses every day. So while Mr. Stewart is getting set up, we will go ahead and move on to the next question. And so another question that we have from our cohort is, what we're talking when we are mentioning a small loan versus a large loan? Are we talking $500,000, $1 million, 2 million, more or less?
Oh, so that's, sorry about that. I'm using banking verbiage. As far as like small loans, it's not really a good price point to say a small loan. I was mainly talking about small business, that segment. So in banking, we have a small business sector, or business banking, I will say. And then we have a middle market. Your middle market is going to be your large corporations. I'm in the business banking side, right? So just to tell you a little bit of a breakdown on M&T Bank, I do deals 250K all the way up to 10 million, right? And then I have a branch partner that I work with that does 0 to 250,000. And then I take on anything higher than that.
Thank you very much for providing that clarification. And so whenever Mr. Stewart is able, I am just going to ask for you to just give us a brief introduction, as well as share just how you help business owners every day.
There we go. Okay, you got me now?
Yes, we do.
So sorry about that. Well, hi, everyone. I'm Eric Stewart. I own EMS Commercial. We're a commercial mortgage lender and broker. So we do all kinds of loans for investors and business owners. If a business owner is trying to acquire property to run their business out of, we help them with that. And we do small to large scale investments from, 100,000 to 100 million. So it really runs the gamut because we're brokers. So I may be helping someone buy a church today, a gas station tomorrow, strip mall the next day, an apartment building conversion. And then also a lot of business owners fall short of operating capital or funds to invest in real estate or in other things, to put money back into their business on a separate company called Wildcat Funding. And our job is to give business owners gap funding for those needs. And sometimes more conservative, more qualified, or heavily qualified existing business that's been in business for 20 years and makes $20 million a year, sure, they can go and walk in any bank or establishment and get money, their business right away. But for the smaller business owner, it's sometimes a challenge, and that's kind of where we fill that void to allow them to have a little bit more ease to get access to money, to money and funds. That's the
Thank you
short
very
version.
Yes, thank you very much for joining us this evening. We are just going to be asking the question both verbally as well as putting a version of them in the chat for your viewing also. And so the next question that we have also does come from our cohort. And so they are inquiring about why banks charge for accepting cash. Even at limits like 20,000, 30,000 per month.
Yeah, so I wish I could answer more on that. Unfortunately, I'm not on the retail side, so I don't have the best details to kind of answer that question. But what I will say, in my experience with clients that come from like a credit union that typically don't charge for accounts, and you come to a M&T Bank where we do kind of charge. So sometimes depending on how much you are doing transactions, I like to say we can try and offset the accounts. There will be fees that come up eventually, but what we can do, and I recommend you doing, is talking to your bank about interest-bearing accounts. So if you do have a lot of money in that account, you will be getting interest on that account. So at the end of the year, we like to see that majority of those fees that you would have got offset by the interest that you would have earned.
Thank you very much. Mr. Holmes, were you going to add anything?
Actually, no, I'm not as familiar with the charges that big banks do. I've only done smaller loans.
Okay, thank you very much. And so another question that we have is, how do I evaluate a lending institution? Are there any specific measurements that I should consider?
Yeah, you should. You should definitely interview multiple bankers before you kind of go with them, right? 'Cause at the end of the day, your livelihood of your business is going to be in the banking hand, right? So what you should do is you should interview banks and you should let them talk to you. Let them see if they answer you honestly. And by that, what I mean is, I may not know all about your business, right? But I know somebody that can, or I can get an answer with you within the next 24 hours, right? So if I don't know anything, I can say, hey, that's a good question. You stumped me. Let me get back to you, either next day or the same day, right? That goes a long way in coming up with something on the fly. Also, how fast are they to respond to you, right? Because if you ask me a question and you have to call a 1-800 number, that's a bad thing. All of my clients have my cell phone number. They call and text me, and I answer. I may not answer all the time, but guess what? You're gonna get my response back within that same day, or next day, latest. You want to see how responsive they are, and because when you guys have answers or questions, you need immediate answers, not to sit on hold. Those are the main things. Really, just seeing the honesty, how well they know your business, and how responsive they are. Because all banks typically have the same products, to be honest. It's really who you're banking with matters.
Thank you very much. And so the next question that we have is actually coming directly to Mr. Stewart. And so the question is, are you able to please explain the process for getting funding for commercial real estate purchases?
Yes. So for purchasing commercial real estate, there are a lot of factors that go into how much you need to put down, what the interest rate is, what the length of time the loan is, whether it has a prepayment penalty or not, whether it's fixed or a variable rate, whether it's an interest-only payment or a fully amortized payment. So there's so many different factors that determine, what customizes this loan. Do I need 20% down and the interest rate is higher? Do I need 30% down and it's interest only with lower payments? Do I have those kind of reserves that are required? So there's so many factors that just goes into knowing what you need for a particular commercial transaction. If you're talking about purchasing an investment property, let's say, and you just want to renovate it and sell it, or if you want to buy it and hold it, I guess the benchmark would be a 20% down payment, single digit interest rate on the buy and hold. But if you need to do renovation, it's a higher interest rate, in the between 10 and 14%. And that's because those are short-term loans. Investors will use those types of loans just for renovation, and then they'll either sell the property or stabilize it, which is the process of having a property fully ready to rent, and with it being income producing by having the prospective tenants in place.
Thank you very much. And so another question that we have is actually going to be in relation to company partners. So when do partners need to be included in a loan application or documentation? And what financial considerations should I bear in mind if I'm considering a partner?
So what I'll say is for banks, you'll need, if your partner is at the 20% mark, 20 to 25, I'll double check again, 20 to 25% mark, they have to be included in the loan. And also what I'll caution people and being so quick to add partners, because a partner can make or break your company, right? Don't be so quick to really add a partner on, especially when you started your business by yourself. I'm not saying you can't get help, but there's a difference between getting help and getting a partner. A partner has equity within your company. They can drain it. They have to be on all forms of, depending on the percentage, they have to be on all forms of loans. And if you're not careful, if your partner doesn't want to be on the loan, like you may not even get a loan anymore because we need a certain amount of guarantees for your loan to go through.
I'll add just one more thing on that. People are often surprised, like, hey, why does my husband have to be on the loan? Why does my wife have to be on the loan? Well, if you all share bills, right? Like if your mortgage, if you all have to pay the mortgage together to keep the mortgage going, right? Then they're an important part of your financial picture. So we often want to see the significant other's financials as well, their credit score and their income. And some folks should feel inconvenienced by it or whatever, but this just is what it is, and you'll have to just be prepared to do it. Also, though, that may make you think that, hey, maybe going forward, maybe we keep our finances separate. And that's that's just a discussion you have to have with your significant other, but it may make it easier. Like if you want to purchase a home and they purchase a home, or do other types of real estate deals in the future, have different businesses, it may be better to keep things separate. So, but you should definitely talk to your attorney, talk to your accountant for tax purposes, and of course, talk to each other to make sure that's something that you all are willing to do or not willing to do. It is a fact.
Thank you very much for adding that piece as well. And so the next question that we have is, what tools do banks use for evaluating markets? Can my banker help me understand my competition better, my customers?
Yeah, so we use vertical IQ. That's what majority of banks use. I use that. So if a client comes to me and they kind of want to know what margin they should be in, go on vertical IQ. It gives me a detailed think of their trajectory, the forecast, where they should be, competition, and we can kind of go through that together, which is why it's good to kind of have a relationship with your banker, so your banker can sit down and make time for you, so you can go through that piece of information together. It's very detailed. I encourage to, if you guys don't have bankers, reach out and I can help you guys with vertical IQ, or you can get it yourself, right? But I mean, as a bank, we pay for that resources, so some of our clients don't.
Thank you very much. And so another question that we have is, does student loan or medical debt impact my ability to receive funding?
Can you repeat that, please? Sorry.
Yes. Does student loan or medical debt impact my ability to receive funding?
There's no yes or no answer to that, right? It depends. It depends on how much you have, depends on what industry you have. The reason why I say that, because it all comes down to debt to income ratio, right? With your personal credit. How much is that affecting your credit? When it comes to medical, I mean, student loan, everyone has student loans. Well, not everybody, but you guys know what I mean. Majority of people have student loans. How much is it? What industry are you in? The reason why I say industry is because I've seen banks be a little bit more flexible to doctors, people within the medical field that have high student loans and stuff, because we know that's they have all that debt, and it's the reason why they're in that field, right? And we know the medical field, they get funding through the government. They have very easy access to payments, so we're willing to be a little bit more lenient with them.
Thank you very much. And so another question that we have is, what are some of the biggest mistakes you see new business owners make? How do we prevent making these same mistakes?
Growing too fast. That's one of the things I see. It's very easy to be tricked on social media. Everyone on Instagram or everyone on Twitter is $1 million business, and we see what they're doing. But what I tell you guys is it's a sweet joy in taking your time to grow organic growth, knowing your business, knowing your numbers, knowing your profit margins. The reason why I say that is because you can be a small business and you are seeing 20 to 30% profit margins. You are an excellent and an elite business. If you grow, your margins may decrease. And then it's like, why did you grow for you not to receive the same money that you were getting at a smaller stage, right? Sometimes growing isn't always better.
I could just add on to that. No logic with their pricing. Just this is what I want to charge, and obviously has some cash flow projections to help you with that. Also, faith-based accounting, that's what we call it, where it's kind of like, Lord, well, let's see how it goes this month, and look, it is what it is. It's a little scary, but just people do it all the time. And then I think also getting a partner. I think through when we talk with people as far as consulting, really, if you just were more patient, took out a loan or paid someone, now you just paid them to do the work as opposed to giving them 20, 30, 40, 50% of your company. Now the problem is they don't want to work as hard. You're upset with each other. You don't have a operating agreement. Those things usually end up causing the organization to fall apart. So taking on a partner where you don't need to, and then of course not having enough money. You're just underfunded, and so many small businesses, especially when you see a small business, unless the person is just incompetent as a leader, usually the reason is that they have service issues, they run out of food, all these things happen because they don't have enough money to essentially overstock or prepare for extreme situations, or overstaff for busy times. They're underfunded. So those are usually the things I see, the mistakes that businesses make as they get started.
Thank you very much. And so another question that we have does come from one of our cohort members. And so they stated that they need a multi-million-dollar loan to purchase a new conference center location. And so they're asking if banks expect a down payment or excuse me, and will they use the equity in their home for a down payment? And so I recognize that this may be a loaded question. Oh, go ahead, Mr. Ojuri.
Yeah, so we do. Majority of banks will require not majority, all banks will require a down payment. Typically, you can see that anywhere from, if it goes SBA, 10% down payment. If it's conventional, you should think anywhere from 10 to 20% down payment. Now, for your house equity, we have to look into that. Haven't seen that happen, but again, if it's in an account and you could justify it, by all means. But again, they have to ask more questions on that in order for me to give you a direct answer.
Did Mr. Stewart chime in on this too?
Yeah, I can definitely add. And so those rules are a little bit different for us, whereas you do not have to go over and above the source where the money came from. So it can come from mattress money. You can put cash in the bank and not have to season it for 60 days and still be able to do commercial transactions. So, it's just a different flexibility that, and it varies, what type of client you are. If you need the bank product or you need to go to direct lender. And so it really allows you to customize what you're doing. Now, when you're talking about pulling money from your home's equity, yes, many business owners, that's one of the best sources, whether it's an investment property or your home you live in, one of the best sources to get money to bridge the gap for down payment, closing costs, and holding costs on a purchase of a property that you're going to run your business out of, especially in that first year. You need a little bit of cushion. So many people do pull equity versus using some of the more expensive ways of bridging the gap. Cash is the best way. Equity is the second best, or a gift, of course, is nice. But from other than that, you can use either gap funding, which is very expensive money, and then the most expensive form of assistance for down payment, closing costs, holding costs, interest payments, reserves. The most expensive place is what we talked about in a question a few minutes ago, which is the partnership. So in commercial real estate and commercial transactions and investment transactions, it's very common to have equity partners. Now, they may be limited in that after your first year, you have an agreement that you're going to buy them out. And that's all going to be spelled out in your operating agreement. But it is very common when you move from business to especially the real estate that I'll just ask a question. How many of you ride by a new development and you see 15 signs out there, Baker's Construction and Susie's Design and, this guy and that guy. And a lot of times those are not people that have been hired to work on that job. A lot of times those are a bigger level of equity partner, which is called syndication. And so as you climb up the ladder and get, into the multi-million-dollar deals, it's called a syndication. We have multiple partners. But certainly at the smaller level, the 5 million and below, it is not, once you start getting up into those bigger numbers and bigger requirements, it's okay to consider having a limited or full equity partner to some percentage of the business, as long as you can, keep control of decision making. Of course, you want to hold on to your baby, but that is the most expensive way, because then you've got somebody that cuts in on the gross profits of the transaction or of the business versus just taking the hit on gap funding or pulling money out of your home and then paying yourself back as the business progresses or the investment becomes profitable. That's the short version. I could go on, and that's kind of what we do with our clients. We kind of act as partners. The way I'm talking to you tonight is the way that we talk to our clients. It's no pressure. We just want to educate you and put all the options out there so you can be smart about it. It's never pressure for the transaction. Some clients I talk to and they're not ready yet, and I'll tell them, put another 6 months and 8 months. Let's build over here a little bit. Let's get some more savings, get the credit together, whatever the case, because when you get on this journey, every investor will tell you as soon as the paint dries and the ink dries on closing, you're looking for the next thing to invest in. So we try to keep a long-term relationship with our folks and support them, not just at closing, but through closing. When they're in that first year period, it's important to help them and give them the resources they have access to.
Thank you very much. And I did get a direct message from the person that asked that question, and they said that you all answered it perfectly. And so the next question that we have is, if we were to go into a recession, what is your advice to keep going?
Live within your means. Live within your means. Keep on doing business.
I'd like to chime in on that. And I would say to prepare for a potential recession, you need to forecast and look at maybe diversifying a little bit and, spreading your wings. Talk to your banker at M&T. If you look at real estate as one of those ways to diversify, put your money to work in a couple of different pockets. So a recession, a depression is bad for the guy that's on the wrong side of it. For the guy on the right side, it turns into massive opportunity. And even if you're not looking for that, but you're just looking for a safety or safety net, talk to your banker at M&T and he'll put your money in place where, get advice about where to place it that it fits your comfort level in your situation.
Thank you very much. And so another question that we have is, I currently have a bank, but I'm not happy with the relationship. Difficult is it to change banks and not miss a beat with my current monthly bills?
So that's a good question, right? It will be a pain in the hair. I won't sit here and lie. If you have a lot of stuff connected with your bank, right? But that doesn't mean you have to stay there. What I tell my clients that switch over, in fact, I'll tell you, I had a client that has about 4 different restaurants, and we had to switch over their accounts, right? So we're doing this small. You don't do everything. You don't do everything all in one day. That's how you miss your payments and you miss payroll. You do it small by small. We start off with the smallest thing you have, right? Smallest account you have, you move that over, and then we connect all the dots. Next thing we go to the second smallest, and then for the operational account, we open up one on our side, but we don't completely close that account you have over at your previous bank. Start transferring money to my bank, smaller and small increments until you can switch on everything over to my bank. That's pretty much how you do it. You do it in small things, not all at once.
Thank you very much. And so another question that we have is, how do you find investors interested in investing in our industry? What's the secret?
That's definitely an Eric question right there.
Well, finding equity partners is a little bit my question, not for your business, but for real estate. So I deal with a ton of investors that that may have interest in, they may have the same problem you have. They may have $100,000 liquid, but they want to do a $1.5 million deal and they need more cash. And it's a good deal. It may make money. And so equity partners often come together and say, let's partner up on this. You know, you'll do the administrative and I'll do the hammer and nails, supervising the crews, you know, and everyone shares the responsibility and splits the profit.
Yep. And to add in on that, if we want to talk on the business side, again, I'm a banker, but I give out debt. We don't invest in companies. But what I will say is if you are looking for like a prime, I guess you will say, to kind of mentor and investing in business, start going to many different events that you know people within your industry will be at and network with those people, see what the bigger businesses are doing. And that's pretty much how you get your foot in the door. It's all about who you know in your network.
And I'll just add just one thing on. Work hard to increase the value of your business. I mean, you know, just like anything else people would want to invest in, you don't want to invest in something that's losing value. You want to invest in something that's gaining value, right? So having the right industry that you're in, making sure that you have standard operating procedures, the right technology, you have things in place so they can run without you. I think also identifying the skill sets that are missing. So if let's say, for example, if I wanted to get in real estate investing, I would probably, hey, you know, Eric, you know that stuff really, really well. I know this part, you know, business operations really well. Let's get together and then we can partner. I'm bringing something, they're bringing something. He has value, I have value. And then, you know, that's usually, in addition to what everyone else started to say, that's a strategy we usually use. How can you create the most value, make your business more valuable? And then from there, identifying what are you willing to give up? As Eric said, you know, with equity partners, you give up a little equity, you give up a little say. So how many of your fingers are you trying to lose in this deal? And then I think also, of course, the last thing is long-term vision. What do you really want to get out of this? So are we just getting into it? We're going to make some money short-term. We're going to make some money long-term, because it's important to figure that out at the beginning, because people may want different things. Having your operating agreement in place so that we know this is a short-term deal, get in and get out. We're going to fix and flip it, or we're going to keep this one for a while and have tenants and make a little bit of money over a long period of time. So, you know, you have to have those conversations and be in agreement and be in alignment, and then everyone brings value. We usually see a much better result.
Thank you very much. And I do believe we touched on this a little bit already, but I do just want to ask you all, should you try to have relationships with more than one bank, or is it better to have all of your banking with one specifically?
I think it's good to have a majority of your business relationships with one bank, and then you can have other relationships elsewhere. The reason why I say that is because it's good to kind of diversify, just like Eric was saying. Kind of good to diversify. If you don't like one bank, you don't have to. Then you're now going through the loopholes of finding your other bank where you already have a small account with one bank. But it's good to have a majority of your bank within one household, so that majority of your business can go through one bank. That bank understands your business, and you can get the bulk of your interest of deposits accounts, stuff like that, all in one, instead of paying multiple fees for your business.
And even though I'm not a bank, I will speak on this subject because it has more to do with where do you want your money? You want to make a choice based on who you trust. And so do you want to trust multiple people to give you information, or do you gather information from multiple sources and go to the person you trust the most to execute? And so I think that going with someone you trust, that you develop the relationship, they know you, they know your business better than ever because you spent time, and you just, you know, it's about investing your time with the right circle, interviewing and vetting. Sometimes, you know, relationships go bad and then you do have to switch. But I would say try to develop the long-term relationship. So, someone, when you call them on the weekend, they're going to pick up the phone and solve a problem for you. So that's my thing on it.
Thank you very much. And so, Mr. Stewart, we do have another question for you. And so we did just want to ask, what are common challenges that you've seen when aspiring investors come to you?
Of course, the biggest challenge is money, because to purchase an investment property, whether it is to hold on to it or to flip it, to renovate it, sell it, the biggest challenge is always the cash. Because if you're an investor, first of all, you're an investor by nature. So cash in your hand is looked at as the devil. You got to get it out of your hand and get it invested. You can't go to work and your money's sitting down retired. The money's got to go to work too. So a lot of investors will come, and if they're getting into real estate investing, they're like, the only experience they've really had, the most experience, has been playing the game of Monopoly, which says collect Park Place, Boardwalk, get all of these different things. They come in guns blazing to purchase a property that's going to make them some residual income, $600 a month, $500 a month. In order, first of all, to pull that off, you've got to trade that for $50,000, $100,000, $75,000, in cash to receive $500, $600 a month. Now you're going to get appreciation on that property. It's a good long-term strategy, but if you're a new investor, you just turned your own lights out. Now you got to go raise another 50 or 100,000 to do your next deal. So those are the two things I see, and two challenges is to change the mindset. When you stop looking at doing this as a transaction, I'm going to get into buying real estate, and look at your real estate as a separate business. So Tom Jones is an individual. Jones Acquisitions is his new broke best friend. And in order for Jones Acquisitions to make their first transaction, they need to borrow money from Tom, right? So he has to fund his own business with this cash that may be coming out of home equity, maybe coming from the retirement account, maybe coming from hard-earned cash. And so he's loaning it to this business. So the business's proposal is the way people come in guns blazing. I'm going to pay Tom back out of this $600 a month that I'm going to make off of this property. If you loaned out $60,000 of your money to a stranger, you would want your money faster than that to get it back. And so the first transaction, first 2 to 3, it's a 3-1 rule for me. First 3 should be buy it, renovate it, sell it. And that's where you get your legs under you. Now, a lot of times the other challenge is having enough money. And again, I went through the 5 sources that you can use in order to get that gap filled that you don't have. Because, folks will walk in and say, I have $50,000, and that's not enough to really do a decent sized transaction that's going to give you enough profit to move into the next deal with you, having some money now in your operating account. So sometimes you need help.
Thank you very much. And so our final question of the evening is, just in 1 minute or less, please just share your final thoughts or words of wisdom for our IVP Cohort 11 members as they relate to preparing for capital and essential financial documentation.
Thank you guys again. That was a good cohort. You guys are in great hands with Will. Will knows what he's doing. He's been doing this for a long period of time, has many different business owners that went through his courses that are now excelling, doing very well. What I will say, and my final piece of advice for you guys, is to know your business and don't be too quick to grow. To grow is great, but really know your business, and you want to make profit before growing, right? Keep it simple. When you guys started it was simple. Just because you guys are growing doesn't mean it has to get complicated. Keep it simple and have fun with what you're doing.
And I'd say my best piece of advice is just leaning back on same thing, which is develop good relationships, grow your Rolodex. Your network is your net worth, and just get good people in your corner that can help you to advise. I never profess to be the smartest one in the room. I am, I'm in the wrong room. You know, I want to learn from the people around me and be able to use them as resources to help me to grow. And I'm a business owner. I own several businesses. I'm always looking for someone to help me with something, you know. And as a business owner, that is something that you have to do, is have good resources. The other thing is, if it makes sense, purchasing the real estate that you do business in is always a good investment, because you know that you're going to be there for a long time, God willing. And if that does happen, that commercial piece of real estate is going to appreciate in value. So you're getting paid for you not doing anything except going to work.
Thank you very much. So thank you again, panelists, for joining us this evening. We are super grateful for your time. The cohort, as you can tell, our panelists are experts in their field, so please be sure to save their contact information, as they have kindly provided it for you via the chat. And so on behalf of Mr. Will Holmes and WHC Consulting, as well as, of course, Ms. Barbara Quay and Anne Arundel County, this does conclude the recorded portion of Week 6, Preparing for Capital and Essential Financial Documentation. Thank you.